Welcome to Tradespoon in the Yellow Tunnel. My name is Vlad Karpel. I'm CEO and founder of Tradespoon in the Yellow Tunnel. Today we're going to have a live trading room open to trade stock and options using our technology. For those of you who are new, welcome. If this is your first live event, do me a favor, type in first. Always want to welcome new subscribers. Disclosures are very important. Please read them. Trading stock and options involve risk, not suitable for everyone. You must be aware of the risk and be willing to accept it in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor CC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. Also, should not be assumed that the future trade picks will be profitable or will equal past performance. All right, these are some of the main concepts or pillars of successful trading, main concepts of trading psychology. First, process versus outcome. Concentrating on the process. The second one is negative visualization and making sure that you go over the different levels that market can potentially reach. And those are the levels at which you want to consider either entering the trade or exiting the trade. If I pull up Tradespoon, the same information available on Yellow Tunnel. So whether you look here, spiders, support 383, overhead resistance is 390, right? So if market pulls back to 383, consider buying. If you're a short-term trader, if you're a long-term trader, this is your entry point. Overhead resistance is 390. I always just double check, right, just to make sure this is what the model says. It doesn't use exactly the same methodology as I do. We are trading at 390, close at 390. That's the main overhead resistance. We are up again at 392.43. So we are basically retesting yesterday's highs, right? We reached almost 394. As I said, 390 is the main support level. We briefly broke above that for a couple hours yesterday and then pulled back. So 393. If you're a short-term trader, I wouldn't chase the market. I would consider exiting that position, or even if you're longer-term trader. At 393, 394, market is overbought. So from this level, we can maybe go up another 0.5% to 393. I would go short. And support is, yesterday's low, 386, pretty volatile session. Today, let's see, any interesting announcements today? None scheduled. So everybody's going to talk, prepare for tomorrow. We have several Fed chairmen, speakers speak, president, part of the Fed committee, and then we have core CPI, right at 8:30 a.m. Eastern, 7:30 Central. So that's going to create a lot of volatility in the market, right? Anytime there's a data indicating whether we are in a recession or whether we are in an inflation, market reacts more so than individual earnings, right? Usually earnings drive the environment because macro conditions don't change, on daily or weekly basis. Right now we're in an environment where the macro data impacting first idea of how persistent and how sticky the inflation is, and the second one, is there an indication or any signs of recession? So all eyes on core CPI. We're up 0.5%. All eyes are on 10-year yield, right? Pretty volatile. It's kind of it's basically retesting this key support 3.5. Right, the idea of 3.5. This is the level back from June, and we broke through it briefly in December to 3.42, and now we're basically again retesting 3.5. That's the level that's been advertised across the media, across all the research reports. You don't have to have years of experience to understand that this 50% retracement and this June high is a very important level. So tomorrow, again, if CPI is in line or better than expected, I think interest rates will drop and potentially drop below, break through this 3.5, because it's been a pretty weak price action. If CPI is worse than expected, right now the expectation that core CPI is 0.2, 0.3 is expected, 0.2 is previous, and the CPI year over year drops to 6.5. Right, so if this is, let's say, negative 0.1, that's a positive surprise for the market. When I say positive surprise, meaning that the market, this is good for the economy, right? Inflation is subsiding at faster rate that everybody anticipates, and then orders will drop below 6.5. That will, if it's below 0.2. Like 0.1, 0, negative 0.1. If this is below 6.5, 6.4, 6.1, then market, I think, is gonna, the interest rates will drop. If we are, at 7.1, same as last month or worse, right? Then rates will have a large move up. Right now, based on the price of action of interest rates, and bond market is usually better predicting than the equity market, is that we're going to have either in-line print or better than expected, meaning that inflation will continue to drop. TLT is up, Treasury is down, and dollar is flat. It's briefly made new lows, right? It broke through this 103.5 level slightly. I wouldn't say it's a decisive breakdown. And again, waiting for the CPI print. So that's the most important data I would pay attention to. VIX is at 20, pretty complacent. QQQ slightly higher. Spider is up 40 basis points. That's about it. All right, let's review some of the positions. Let me know if you guys have any questions. We pull up the positions. Give me 1 second. So the only short position, again, is this idea of trading around selling premium, right? Selling premium, you look at the support and resistance, right? In the ideal world, if we get close to 390, right? So if we get close to 391, and we did, right now we're actually 392, or you look at the previous session high, right, as a suggested overhead resistance, then I would consider selling call against it. And if it reaches 383, consider selling put. Yesterday it was 385, so I did sell put. Right, I had a call when the market was overbought. I closed the call, and then I rotated in the short put. Right, and always have a well-defined risk. It's a put spread. Right, I'm doing wide put in F spread, bid in F spread. Why? Because I want stock to be sensitive to short-term price fluctuation. If it's a tight spread, 265, let's say 267, then I almost have to wait till expiration. But because I did a wide bid in F spread, then it will move significantly faster. So I sold to open for 97 cents. I put in order to buy back for 15 cents. And looking at this point, what is it? 80 cents minus the hedge. 80 cents, 30 basis points. So I'm looking for 30, 40 basis points on puts and then 30, 40 basis points on calls. So around 0.5% to 1%. And the advantage of QQQ is that it trades in very narrow bid and ask spread. It's very liquid. And it expires every day. So I can do this trade for Wednesday. I can do this trade for Tuesday. Thursday, I'm not going to do it because there is a CPI data, right? Last time we tried it, was XLK. Bid and ask was a little bit wider. And CPI, after the CPI print or after Jerome Powell, not February, but after the announcements of interest rate decision, market moves outside the range, right? The question was, why would you do this if the volatility is so low? Well, I'm doing short-term trades and volatility is not going to impact this unless there is some kind of news. And, I can look at the economic calendar and know what the news will be. So this way, I'm probably not going to get enough premium to justify the risk. Or even if I do, market is very trading in a very well-defined range, right? For very long, right? It just start breaking out, right? Spiders just start breaking out, but fall in terms of in purposes, it's been trading in this range for basically almost 3 months, right? 1, 2, 3 months, right? For 3 months, it's trading 410 and 375. That's a pretty narrow, pretty tight range. At some point, it has to break out of this range, right? And I think this is going to happen starting this week and into the end of January. We have CPI data, we have Fed speak, and then we have people coming back from vacation, right? And then we're going to have, we're also going to have earnings season, right? Starting tomorrow and Friday, we have not a lot, but we have start of the earnings season where the banks, the semiconductors, the healthcare, the travel industry are going to start giving us a glimpse into Q4, right? What happened last quarter? How much has it affected how much economy has affected individual stocks? All right. So for now, I'm done with the short-term trades, right? I don't have anything expires, this week, next week. Next expiration is March, right? Next expiration is March. I did not, the FAA snafu or FAA issues, no, I did not. I was actually made it on time, left on time. So I'm here. I am here. Okay. Let's review the other positions. Any other questions? All right. IWM. So Russell 2000 bearish position in March, right? 190. Credit call spread, credit put spread was the idea that most likely Russell 2000. Similar pattern. It's facing 200-day moving average, facing 50-day moving average. It's slightly broke to this downtrend last time, right? Probably can shift it up now. So I think it's going to have a hard time to break through this overhead resistance. And that would be the setup for almost all the asset classes, right? You have clearly defined downtrend. You're facing kind of classical 50 to 100-day moving average, facing the downtrend. If you look at the, let's see, IWM. At 182, it's overbought, and 6 months, 189. So it could get, again, you can have this marginal breakout, right? Model basically says we can get to 189, 190, right? Retest November, December highs. It's still possible. We have to have, positive news from CPI and earnings, and decent earnings from JP Morgan, Bank of America, and Delta Airlines. So it could, have this 4 to 5% rally. I still think by whether we have a pullback in January and February, or maybe March and April, we'll have it. So I do have March position, so I have time. If I see that we are trading above this 190 level for a couple of weeks, then maybe I need to close this trade and roll it into June, because I don't know whether we're gonna retest 52-week low first quarter or second quarter, right? Basically it depends on the earnings season, right? It's hard to predict exactly what's going to happen during earnings season. Today is a mess. Yeah, good that I left yesterday. Yeah, I got lucky, so it's good. So that's Russell 2000. NOC continue to trade around this position. I did trim yesterday, right? I did trim yesterday. I bought at 491, closed at 499, captured 2%, a little bit less. So I did buy at 527 last time. Next level, I'm waiting for 541, right? 541. So trading around NOC position. The rest of the QQQ position, I'm short, right? So let's see, 265. Can I close? 265 put. So that's will expire worthless. You can close it for penny, I think. Let me see, I'll put an order to close it for. $0.03. But the rest of the position bearish, right? I have 280, 290 March. I have 250 put. I have 270 to 80 put spread, right? If with single puts or single calls, you have to be careful. You have to be confident that we're going to revisit 52-week low at least by March, right? If you're not confident, then I would do a spread, right? If you're not confident, then I would just. If you're not confident, I would do a spread. If you're really confident, this earnings is going to be worse than expected, right? Fed will not pivot; they'll remain hawkish. Then you can do 250 put. Obviously, the advantage of 250 put that there is no limit to your gains. The advantages of spread is that it could still be a profitable trade even if we don't reach the 52-week low, right? If we have sharp pullback, it could be a profitable trade. And the short put is losing money, right? You can see the long put is getting more expensive, but the short put is getting less expensive. SH, if you're not comfortable trading, hedging your portfolio using options, one way to do it is with SH. I also initiated TLT position. So I entered TLT, small position again, using dollar cost average, similar to the approach for NOC, right? $1 million question is how much money are you willing to risk per trade? And I actually started researching what do other people say and recommend. I think consensus is across the board, right? You don't want to lose more than 2.5% of account value per position. And majority of the people basically says, especially if you trade in options, you don't know, because you have to be right on magnitude, time, and direction. And 9 out of 10 times you cannot be right on time, magnitude, and direction. So idea, break this trade into at least 2 and risk 1% of your account value per position. So you open up account with $10,000, you don't risk more than $100. If the trade goes against you, right? If the trade goes against you, or even if it goes in your direction and you feel like there's a confirmation, then you can put another 1% of your account value into that trade. And usually people would do different strikes and different expiration marks, right? They will do the latter, right? And then maybe another 0.5%. So that is $1 million question, right? This is the most important decision. This is the most common mistake that we all make. I do it all the time, right? I get excited, fear of missing out, fear of future regret, and all of a sudden I either risk more than 2.5% of account value. That makes me a little bit nervous. Plus, or I trade more than 4 positions, right? 6, 7 positions. I get overly excited. You know, maybe I should buy Tesla. Maybe I should buy Boeing. Maybe I should buy JP Morgan, and so on. And then I don't check the position. All of a sudden, I have 8 positions instead of 4. So always look at the drawdown, right? If you have 2.5% of account value in 4 positions, that means at any time you're risking 10%, right? Right now I'm bearish, but you know, last year I wasn't always right? Sometimes I would be bearish, and market would rally 15%. Sometimes I would be bullish, and market sells off 15%. So if I'm down 10%, right, then I can recover, right? You know, we had 3 or 4 of these 20% rally or 15% rally, 15% sell-off. If I'm wrong 1 out of these 4, you know, even if I'm wrong 2 out of these 4, and I'm risking 10% or less, right, I can recover, right? I can recover from this trade. But if I have this one of these situations where I'm on the wrong side of the trade and I'm down 20, 30%, very hard to recover. So that is the main driver behind my decisions, right? It's the approaching, how do I approach risk? How do I approach risk? So dollar cost average, option lettering, you can search internet. Very common topic, well covered. Investopedia usually have good articles or definitions of how it's working. I would encourage you to review this. Or dollar cost average, right? Dollar cost average. Again, the problem with dollar cost average and also option lettering is that you cannot do this if you're risking 2.5% per trade, right? If I put on a trade and I risk 2.5%, it goes against me, and then I'm going to start building ladder with 2.5% different expiration months and strike price. Well, guess what? They're highly correlated, right? They are highly correlated. I mean, my March position, bearish position, highly correlated to June position. Maybe it's not going to move, you know, maybe the delta is not the same, maybe the gamma is not the same, maybe the theta is not the same, but highly correlated, right? For the purpose of retail traders, almost identical, right? And one would argue, you know, my QQQ puts are also highly correlated to XLF puts, right? If, you know, Russell 2000 is up 80 basis points, then QQQ is up 70 basis points, and names are up 50 basis points. They're highly correlated, right? So your JP Morgan position is going to be highly correlated to your Deere position. So for that reason, if you're a short-term trader or medium-term trader, and we are trading in the bear market, this is an important rule, which I would propose not to break. So that's all I have. And then XLF put spread. So for now, pretty bearish. Periodically, one can argue like what I did was even XLK when I sold the put and the market sold off. I can look at my position, right? They're all bearish, right? I don't have a single bullish position except the spread that, you know, some of these legs are bullish, right? I do have 38 long call. So then I could kind of come in and basically say, you know, QQQ or XLF, you know, probably will be volatile, right? Probably will be volatile. So I can sell maybe 35 call, let's say, right? Let's say after CPI, I don't think we're going to break through this level, right? Or we have a crossover of, what is it, 50-day moving average versus 100 or 200. Right. So you have 50-day moving average above 200-day moving average, right? Cross all, these gold cross covered everybody, right? Dollar is the same thing. Internet is lit up that, this cross of 50-day moving average. This is the soft landing story, right? 50-day moving average cross the 200-day moving average to the downside. Dollar is going to continue up. This is the soft landing camp, right? Then from technical perspective, 9 out of 10 times, not 9 out of 10 times. I think the statistics is 6 out of 10 times or 7 out of 10 times. So 60 or 70% of the time, when you have this crossover in the dollar, there is a continuation to the downside. And that is one of the arguments from soft landing camp, right? That if dollar drops, well, then the Q4 earnings should be pretty decent, right? Because dollar significantly dropped, much better than the 3 months we had, or 6 months, first 6 months of last year. So that's soft landing argument, and you're going to see that across the board of the value stocks. So XLF is the opposite. So then means that banks going to do well and continue on. Obviously, it's not 100% of the time, and it's not even 70% of the time. I think somebody said 66, 67% of the time. Better than flip of a coin. Better than flip of a coin for sure. So then, for that reason, you can sell short-term put, kind of just to offset the losses. If CPI data is better than expected and we have a rally, right, then you can offset some of that losses. Now that I'm thinking about this, maybe I should do that. We can do this XLF, right? The advantage of XLF, it's liquid, 35 million shares. It gives you 2% interest rate, and you can do it on a small account. I can do one contract on a small account. So let's give it an example. Option, XLF or QQQ, both. I'll do QQQ. Stay consistent. All right, so tomorrow before CPI, if I'm bearish, right? If I'm bullish, I won't do this trade. If I'm neutral, I wouldn't do this trade, because tomorrow there is a good chance that this trade will go against me, all right? So QQQ, let's do 1 hour. All right, so obvious support is 269. I can sell right now 267 put below that level, kind of. If we drop to 267 level, then you know that the market is probably going to retrace back. So 267 I can sell for tomorrow. And that's the advantages of the options, right? They basically tell you what the market expects tomorrow is going to happen. And then I want to have the hedge, right? So market basically tells you that by end of tomorrow, right? By end of tomorrow, a lot of people, 30% chance that market can trade below 267, which is pretty large move, right? In one day, 275 to 267, 7 points, 2%, 2.5% move to the downside or upside, right? You can sell calls and sell puts. So that's what I would do. If you're, or vice versa, right? If you're overly bullish, not overly, but if you're bullish right now, right? Maybe if QQQ is up 0.5% and your portfolio is up 1%, I mean, I would maybe take some profit from some of the position or sell short-term calls, because two things are going to happen, right? If you're bullish, then, soft landing, there will be a, soft landing campaign will push the market higher if there is a better than expected, beyond what the implied volatility of options show, or vice versa. But if it goes up, you're making money, right? Because you're bullish. Or if you're bearish, if it goes down, okay, I'm going to lose money on QQQ, but my overall portfolio will have significant increase. So that's the thought process. If you're market neutral, I would not do short call and short put, because last time we did this, market moved 5% in 2 days, right? So we could have a situation where tomorrow it moves 3% and then Friday it moves 2%. And all of a sudden we're much lower than 267. All right, and then the question is, how much money am I willing to risk? So the January 12th, and the put 267 put, right? 267 put. How much money am I willing to risk? Okay, 267. And the 259. And the 261. Okay. And I bought 261. So I'm risking $6 to make basically 80 cents, right? So still good, right? On basically 10% profit in one day, right? So it's a really good return on your investment. And most likely it's not going to drop to 261 in one shot, right? My exit strategy, again, if it's 10,000, I mean, on $10,000 account, I won't trade 267 QQ put, right? For the reason, because we can reach 261 by Friday, right? You can see it, it's 22 cents, so there is a probability. If we have this, worse than expected inflation jumps, JP Morgan has horrible earnings, all of a sudden we're at 261 by Friday. So it can happen. It's not like a 1 in a million chance. It's a lot higher chance than winning a lottery. So, but my risk is right now 6 minus, let's say, 1 is 5. So $500. If I'm down $500 on $10,000 account, right away, I am violating my rule and I'm down 5%. So this trade is unacceptable, right? Then if you have $10,000 account, okay, then maybe buy 263 put, right? Buy 263 put. Right. If you have, for doing short-term trading where you have to open close the same day, right? To do these type of trades, you have to have $25,000 in your account. You have to be otherwise you can be marked as parent day trader, right? If I open this trade and it goes in my favor and I want to close it for 10 cents, right? And I close it the same day and and open any other trades that day, I am parent day trader. And if I have less than $25,000, you will get on a margin call. If you have the margin call, all of a sudden, your account could be restricted. So to do these type of trades where you're trading on daily basis, you have to have $25,000. On the $25,000 account, if I'm down $500, that's 2%. I mean, I'm not super happy, but it happens, right? 1 out of 10 times, market can move, 4 or 5% in 2 days, right? That's possible. Right, from 274, 261, 13 points, it's 5%, right? So that means Thursday and Friday market can move 5%. We've seen that many times, right? We've seen this many times when when either Jerome Powell speaks or we have this hot or cold CPI data, right? So it's not, it has 10-20% probability that we might be 5% move. Any questions on this trade and thought process? And that's another very important point because sometimes people will ask, what would you do if you had this QQQ put or you have this QQQ call? There really no kind of universal answer, right? This is a perfect example where, if you're bearish, then maybe it makes sense to put this bullish trade to offset some of your losses in case CPI is better than expected, right? So it makes complete sense. But if you are bullish, I would say this trade does not make sense because you're over leveraging your account And if the trade goes against you, not only you're going to lose money on this position, but you're going to lose money on the rest of your portfolio. So that doesn't make sense, right? If you have $10,000 portfolio, this trade does not make sense, right? So depending on your level of experience and more importantly on how much cash you have and what your account value is, some of these trades do and do not make sense. That's why I encourage you to always participate in live trading room. And if you're busy, part of your subscription, you do have your recordings, right? At least when you come home and have dinner with your family, and instead of watching CNN or Fox News, you know, spend 10 minutes reviewing the video to understand, you know, what the context of this trade. Can you review your XLF short spread? I'm down 50% of the March short spread. So question was on XLF. So I do have March spread. 35 put has dropped 50%. If you still hold on. I mean, right now I wouldn't do anything. It is trading against me. You know, I think XLF has moved beyond my expectations, right? We're back to 35, 36 level. I think there's little risk. I mean, there is a little reward, right? I don't think we're going to break through this level, right, from technical perspective. But again, just because I think that way, this is based on technical analysis. I don't have any control over what the CPI data will look like tomorrow or what the earnings from JP Morgan and Bank of America will be. So you'll know right away whether this trade is successful or not, probably by end of next week. So we have March position. I have time. I mean, unfortunately, it is down already 50% or more. At this point, I would just wait, right? There's two things are going to happen, right? Two things are going to happen, right? It's trading in this box. It's been trading since April in this box, right? So since April, it didn't go anywhere for the past 8 months. Right, it visited the lows 30, and it visited the highs 36. It's either going to do this, right, and this will be soft line then, right? Then, you know, Goldman Sachs was right yesterday, right? We are in soft lines then, not hard lines then. Or it's going to do this, right, hard line then. So it just depends what the outcome of these earnings. I still think, you know, even if we do this, I still don't think it's soft landing. I think it's just, you know, Q4 because of the weak dollar, you know, companies are actually outperformed the expectation, and it still hasn't, you know, this elevated interest rate environment has not affected the earnings that much in Q4, right? I mean, there are signs, right? Goldman Sachs is laying off people, you know, everybody's laying off people. Usually the layoffs, that means, you know, the margins are contracting and revenue is contracting. So there are signs, but maybe, you know, the expectations are already very low, right? Expectations for Q4 earnings are already very low. You know, I think even like negative earnings growth, right? So if the expectations are low and the bar is set low and they're able to beat that, I think still, I don't think it's going to be a soft landing, but the smart trade will be, obviously, it will be a losing trade, right? All it means is that most likely this breakout is not going to happen the first, you know, 6 months, probably going to happen, you know, the second 6 months. But the soft landing narrative will be dominant, right? Because then this is the fear of missing out, right? If we break through this level, then people are going to say, okay, I'm done listening to Vlad and, you know, half of the other, you know, analysts, you know, I'm jumping on the train. I'm jumping on the train. You know, I personally will not buy, even if it breaks to this level. Obviously, I would have to take a loss in March, and you know, I would roll it into June. All right, but that's my plan. That's my game plan. I don't, even if we break to the upside, I don't think it's a soft landing narrative, right? I just think it's going to be more of a fear of missing out, right? And you know, if JP Morgan has, you know, decent Q4 earnings, then Q1 earnings, they're not going to happen. And the theory, you know, the hard landing camp basically says, we're going to be at 10 years or 2-year yield at 4-5%, right? Jamie Dimon yesterday said 50% chance we're going to be at 5.25, 50% chance we're going to be at 6. Both of these scenarios imply we're going to be in recession, right? If we're going to get 6, it's going to get either, it's going to get worse, right? If inflation is persistent and we get to 6, he's putting 50% chance. Jamie Dimon knows about economy a little bit better than I do. The other 50 chance we stay at 5.5 or 5.2, right? We have 25 basis points raised 3 times in a row, February, March, January, February, March, or I guess next one is February. So February, March, April, right? Another 25 basis points each time, and then pause. So in both scenarios, to me, that means it's a recession, right? By textbook, you can have service PMI and manufacturing data contracting, interest rates staying at 5 or 6% for 2 years, and you don't have a recession, right? When the interest rates were, 0.5%. So that's the hard landing argument, right? That's the hard landing argument. Soft landing says that history doesn't have to repeat itself, which is, it's a good argument, I guess. It is a good argument. Okay. So that's XLF trade. Am I expecting lower or higher CPI number? Full disclosure, I'm not an economist. I don't have a degree. I took, I took economics, macro and microeconomics classes. My daughter, who is a sophomore in Champaign, knows more about economics than I do. So it's but I can tell you, but I do a lot of research. I'm addicted to Twitter. I'm addicted to Wall Street Journal. I look at it multiple times a day. My wife makes fun of me. She said, spending time on Instagram and TikTok is a lot more useful. Maybe she's right. Maybe she's not. So I do research and I read, and the expectation, right? This is the expected number. This is the previous number. The expectation that it is lower. Usually these economists just, are right? That we're not going to have 7.2, right? So if I have to guess, it'll be lower than 7.1. Expectation is 6.5. So then I don't really care if it's better or worse CPI number. Like you're saying, is it lower, is it high? That's irrelevant, right? It's irrelevant whether it's lower or high. What's relevant, what is it expected by the economists and what will actually happen, right? If the expectation is 6.5 and we get 7, that's a big surprise. If the expectation is 6.5, and it's 6, that's a negative surprise. So the question, I would encourage you, Ricardo, to think about in terms of what is expected, right? Going back to game theory, right? It's really irrelevant what I think, right? Or what you think, for that matter, right? It doesn't matter. You don't try to guess whether CPI is going to be better or worse. But you need to try to predict, or at least, if you want to try to predict what the outcome of tomorrow. I think outcome of tomorrow is 50-50 chance, right? It's a flip of a coin, right? People who say we're going to have a rally tomorrow, they're just conditioned and they're in soft landing camp, right? It's a self-service bias. I'm in the, in the hard landing camp, so I'm going to say that CPI data is going to be, not as good as everybody thinks, and we're going to have a market is going to be down, right? So I'm conditioned to say market is going to be down because I'm prepared for soft landing, hard landing narrative. For every Vlad, there's another person who thinks soft landing and market is going to rally tomorrow. So game theory is the right approach, right? You're trying to figure out who are the market participants, what is the current narrative, and what other people think, and will there be a positive or negative surprise? By nature, I don't know why I do that. I always think that there will not be positive or negative surprise. I believe the best approach is to look whether the market is overbought or oversold, right? I think, based on technical analysis, market is overbought, and CPI is going to be in line with expectation, and market will drop, right? I think that happens more often, right? If we were at 350. If we were at 350 facing 52-week low, I would think the opposite. I think the CPI would come in as expected and market would rally, So I still make my decision based on technical analysis. I see overhead resistance. I see, looking at the spiders 6 months prediction. 394, to me, this is the most important, right? I think at least half of the people think we're going to have a really good CPI, but based on the technical analysis, we are facing overhead resistance, so market is going to pull back, right? I'm like Mike Wilson, easy short. I don't know how easy it is, but okay, that sounds good. But again, it doesn't have to be that way, right? The point is that that's what I think, and that's why I'm bearish in my portfolio. But you could have positive surprise. KBH, thank you for letting us know. So KBH announced earnings today. But I mean, in line, right? Up 2%. Spiders are up 0.5%. Okay. Okay, thank you for sharing. Okay, so the question is, would you buy spiders and SH? Right, if you trade in stock, I would buy spiders and SH. Then the question is how much? Is it, you put $1,000 in SPY, $1,000 in SH, then you're really not achieving anything. But right now, you could, you could see what I did, right? What did I do? I'm basically short-term bull. I bought QQQ, and at the same time, I have SH. But it's in different ratio, right? Right now, if I look at my overall portfolio beta, I am negative, right? I'm bearish. So if you're not comfortable trading options, I would buy spiders and SH, but I wouldn't buy them in the same quantity, right? As I said, you have to have an opinion in the market. It's very simple. You either in the hard landing camp, sorry, wrong place. You either in a hard landing camp or you are in soft landing, right? And I gave you an example yesterday from the Goldman Sachs. That's how everybody coins these terms: hard landing, soft landing. If you're in soft landing, I would encourage you to obviously have more spiders than SH, right? You just have SH in case market is facing overhead resistance and cannot break this, right? That's possible, right? So I would buy, more spiders than SH. If you're in hard landing, I would do the opposite, right? Because we could break through this at least briefly. Right? If the earnings season is stellar and CPI is data better than expected, then the dominant theme, at least for the next 3 months, is going to be soft landing. The soft landing guys are going to come out on TV and make fun of hard landing guys. If market pulls back, then the hard landing guys will come out on TV and make fun of soft landing guys, right? But in reality, it's just you just got lucky, right? This one time you just got lucky, right? If you're in soft landing and the market breaks through this, it's an element of luck, not element of skill, right? If we end up at 480 at the end of the year, then it's a skill, right? You called soft landing, you had your own reasons, and you were right. That's a skill. But because it breaks for 2 months and then does this, then it's luck, right? And then it's luck. Okay, what else? University of Wisconsin, go Badgers. All right, Jeff, thank you. Stock forecast, $2. So the question, but it's only done once a month. Yes, long-term prediction is once a month. And the idea that if you're a long-term trader, you don't want to change your opinion every single day, right? So it is done once a month because it analyzes the past 30 years. And based on that, 394, the market is overbought. If it jumps to 400 and 405, does it mean that the model is wrong and it's just a waste of time? No, all it means is that market is extremely overbought due to certain instances, certain data points. The new data pushed the market above 394. But if we don't have a new data, if inflation is the way it was and the way it will be for the next couple of months, right? The idea that there shouldn't be any large surprise. Everybody expects inflation slowly subsiding. Everybody expects inflation to stay elevated at least until the end of the year. That's the current expectations. Most likely, this one data point is not going to change the long-term picture. Short-term, yes, it could move 5% up, 5% down. But the long-term thesis, right, the long-term expectation This one data point is not going to change anything. Everybody who you talk to expects inflation to continue going down. The question is, nobody knows whether once it goes down, it will come back up, right? Nobody knows that. Inflation could go down and then can go up. That people don't know. And nobody knows whether we're going to be at 2% by the end of the year, or we're going to be at 3%, or we're going to be at 4% at the end of the year. Last year, everybody said we're going to reach, 3% by end of 2022, right? In the beginning of 2022, everybody thought the inflation would be basically contained by end of 2022. Everybody was wrong. Everybody thinks by the end of this year, Fed will pivot and inflation will be close to 2%. Honestly, if I have to guess, most likely majority of the people will be wrong, right? The inflation is stickier. It doesn't have to be 70s and 80s, but it should not be, magic wand and then inflation just drops, right? I was listening to the interview yesterday of CEO of Conagra Foods. Foods inflation is a lot more persistent. Last year it was 15%. This year it's still double digits. It's still over 10% inflation in food, right? Everybody thinks that rents are going to drop, whatever they are, 20% to 10%. But I know rental prices, you have a contract for a year and then people renew and, people are still working remotely and they're, everybody's going to Miami with their families. Probably rents are also going to be, elevated beyond the end of this year, right? So that's the way to approach this is just to see what other people think and is there a positive or negative surprise. Yes, TSM, I will consider doing earnings play, right? So we're going to do earnings. Please watch, what's today? Wednesday? I will do TSM is a good stock. I like TSM. I will do probably both short puts and short calls. Is it tomorrow morning? Let's look at our friends' stacks. KBH, earnings, TSM, before market open, right? So I will do TSM before market open, yes. Before market open, I will do TSM. See, do I have it here? TSM, yes. That is my favorite, one of my favorite stocks. Okay, and it's under 100. Thank you, Karen. John, thank you. Yes, I think Stock Forecast Toolbox is a really good tool. I mean, there are other good tools, but it's kind of unbiased, right? It's machine learning, it's artificial intelligence. It has no idea about CPI tomorrow. It has no idea about JP Morgan earnings. It basically tells you, all things considered, at 394, we are overbought. Can we go higher? We've seen it to go higher as much as 5%, right? So if the market trades at 415, first week of February, I would not be like overly surprised. It's totally possible, but it's extremely overstretched, right? You pull the string too much. No, okay. Thank you, John. No. All right, so John is in hard landing. Okay, and so am I. Okay, dozen X $7. Yeah, LTMH. Is it Louis Vuitton? Is that what we're trying to do? Louis Vuitton? It's not LTMH, it's some other symbol. What is it? LMTH? Just give me the right symbol, because I think you were trying to look up Louis Vuitton, but I don't know if it's LTMH. And John is always right. Yes. All right, any other questions? So I would I think market is going to become volatile, right? It's get a lot more volatile. I don't think VIX is going to stay at 20, right? VIX is either going to probably drop to 15, right? VIX is going to drop 15. If it's a soft landing narrative, then VIX drops to 15, or VIX is heading to 30. So I would review your portfolio, right? If you're in soft landing camp, QQQ is up 1% and your portfolio is up 1%, I think you're fine, right? If QQQ is up 1% and your portfolio is up 3%, I think you're overly bullish, right? And hard landing camp could be right. It doesn't have to be, but it could be right. If you're in a hard landing camp and QQQ is up 1% and your portfolio is down 1%, I think you're fine. If you're in the hard landing camp and QQQ is up 1% and you're down 2 to 3%, I think you're overly bearish, right? You're overly bearish. Consider, maybe selling a put spread, maybe closing some of your short positions, but you're overly bearish. That is what you want to do going into end of the month, right? Because this week and next week, expect VIX to move either to 15 or 30. All right. That's all I have for today. Thank you very much. And I will see you tomorrow morning, right? Tomorrow morning, or today at 12 p.m. Strategy Power Table. Strategy Power Table tomorrow on Yellow Table. Again, please, YouTube subscribers, thank you very much. I know there are a few of you on the broadcast, right? You have 8 people watching. That's good. So thank you for watching. Thank you for participating. I know a lot more people are actually, view these afterwards. 60, 100 people. We're at 931 subscribers. If you watch the video and you please click like button, click subscribe. If you haven't subscribed, please subscribe. Hit the like button. If you watch the Strategy Roundtable and you think this is good content, please share the link on Twitter, Facebook, group, Instagram, or any other socials. Just email it to your friend. If you know anybody who's trading, hopefully if this video help you manage expectations, manage your risk, look for opportunities in the market, it'll probably be useful to other people as well. Thank you very much, and I will see you tomorrow morning. Thank you. Oh, wait. I almost forgot. We'll finally release this tank, right? John, I don't know if you're still there. I have to remember, I'll leave it here. But destroy the tank, right? So we actually are able to deliver tank to Lviv, right? I'm part of this nonprofit organization, gate.org/tank, right? And obviously, the idea is that millions of people are displaced, don't have heat, don't have food. They're still being bombed every single day, or at least every single week, right? Every single week there's they're bombing infrastructure. So we built these, took the tank, right, cut it into pieces, and now you can buy the tank. And we do have project ambassadors, Valery Zaluzhny, Commander-in-Chief, and Kirill Budanov, Chief Intelligence Office. So consider, either donating or buying this piece of symbolic history and help Ukrainian families. Gate.org/tank. Oh, John, thank you. I appreciate it. Thank you. But if you want to buy the tank, that's the link. Thank you. You can open up it. Yeah, you could talk to. I'm on the board, but I don't do day-to-day operations. So if you have questions about the site or how to buy more or less, open up a support ticket. Send them the email. I don't have a contact arms. Okay. All right, John, thank you for your support and help. Everybody else, thank you very much. And I will see you soon. Thank you.